next thing that we're going to talk about in this chapter is preferred stock. Preferred stock is a different class of stock than common stock. Preferred stock has a little bit different rules than common stock. One of those is that they normally have zero voting rights. So the common stockholders are the voters, and preferred stock doesn't have voting rights. They usually have a stated dividend rate that we pay out to preferred stockholders. Preferred stockholders have priority over common stockholders in dividend payments and the distribution of assets in case of liquidation. So remember when I talked about the distribution of assets in case of liquidation in video 1, this is whatever's left if a company decides to fold, sells everything off, we pay all of our bills, then whatever is left gets distributed among the common stockholders. If a company has preferred stockholders, they get first say on that distribution of assets. They receive everything, then if there's anything left over, it goes to the common stockholders. Of the corporations that are in existence, only about 27% have preferred stock available. So not all companies issue preferred stock. We can have cumulative preferred stock or non-cumulative preferred stock. If we have cumulative preferred stock, that means their dividends collect every year in an account called dividends in arrears until we pay them out in cash. Those dividends must be paid in full before we can pay any dividends to common stockholders. So what happens is when we don't have enough cash to pay our preferred stockholder dividends, we would say, we'll pay you next year. Then next year we owe them 2 years worth of dividends. For non-cumulative preferred stock, prior years do not have to be paid in future years. So they don't accumulate every year that we don't pay out. What we see in the bottom chart then is how it looks on our balance sheet in our in our stockholders equity section. Here we have common stock of 50,000 shares, authorized 30,000 shares outstanding, and we have 50 shares issued and outstanding of preferred stock. The dividend preference of preferred stock. So when we're looking at this, we have a corporation with outstanding stock. They have 1,000 shares of $100 par value 9% preferred stock with potential dividends of $9,000 per year. So that's 1,000 shares times $100 times 9%. And they have 4,000 shares of $50 par value common stock. If the board of directors declares a 5,000 cash dividend in 2019, so in 2019, we were only able to pay part of that $9,000 per year of preferred stock. If that preferred stock is cumulative, in the next year we would have to pay everything we didn't pay the previous year before common stockholders received any. So underneath here we see if it's cumulative, we paid 5,000 of that $9,000 in the 2019, which in 2020 we have to pay the rest of that 9,000 and another 9,000, and then whatever is left can be distributed among common stockholders. If it's non-cumulative, then in 2020 we don't have to pay that remaining 4,000. We just pay whatever their yearly stock dividend is with the $9,000, and then the remaining goes to common shareholders. We will do examples of this in class. So we have this example of the cumulative versus the non-cumulative on this chart here. We can also have participating and non-participating preferred stock. So with participating preferred stock, dividends can exceed a stated amount once common stockholders receive a dividend equal to the preferred stated rate. And in non-participating, dividends are limited to a maximum amount each year, and that's the stated dividend rate. So this is where if we say it's a 9% rate, then that's the largest dividend they can receive. If we're participating preferred stock, then the company can choose to give us more stock after they've already paid the common stockholders. Why might we issue preferred stock? Well, one reason is to raise money without sacrificing control or distributing ownership. So this is similar to why we would sell bonds versus stocks. Another one would be to boost the return earned by common stockholders through financial leverage. So maybe we only offer preferred stock to people who are already common stockholders. And another one is to appeal to investors who want to own stock but don't feel that common stock is safe purchase. So because the market value changes on common stock and we aren't promised dividends on common stock, we might be more inclined to buy preferred stock where there's a guaranteed dividend. Treasury stock is a company's own stock that they have bought back. So this is outstanding stock that the company has decided to buy back. There's a multitude of reasons that a company might buy back treasury stock. One is to avoid a hostile takeover. So if someone has gotten a higher percentage of ownership or has a higher enough percentage of ownership in stock that they could come and try to create a hostile takeover of the corporation is going to want to buy back some of the stock from the market to decrease ownership and people who might collude. They also might reissue to employees as compensation. So they might buy back some of their outstanding share in order to give it to employees. They can also do it to maintain a strong market. So this is the supply and demand thing with economy. If there's a lot of supply, there's not always so much demand. So if we see that demand is low for our stock, we're going to pull back some of it back so there's less supply available and hope to create a stronger demand for it. When we purchase treasury stock, we show it on our balance sheet in our stockholders' equity section. We purchase it at market price. So we have to buy it back at open market. It is shown as a contra equity account. So it's shown as a negative balance in our total stockholders' equity section. Our statement of retained earnings is our total cumulative amount of reported net income less any net losses and dividends declared since the company started operating. So we've already looked at statements of retained earnings in previous chapters. So now we have our statement of retained earnings where we're going to include if we have common stock and preferred stock, or if we've paid any dividends or had any losses. We can have restricted retained earnings. So one of those is a legal restriction. So states restrict the amount of treasury stock purchases to the amount of retained earnings. So companies can't buy more treasury stock than the amount of retained earnings that they have. We might also have a contractual restriction. So this is if we have some kind of a legal agreement that says in order to have this agreement, we need to have a certain amount of retained earnings. This can restrict us from paying out dividends because we have to be able to have the retained earnings to pay dividends. So when we look at a statement of stockholders' equity, we look at the differences in what changes have happened to our stockholders' equity section. So we've paid cash dividends, we have our net income that went into retained earnings, we issued stock, and we repurchased stock in treasury stock. The last thing that we look at in this chapter are looking at some of the common formulas that we use for calculating how well a company is doing. Earnings per share we have as one of the most widely cited accounting statistics. Most publicly traded companies put their earnings per share on their financial statements. It's included in a line under their income statement. So we have the basic earnings per share equals our net income minus preferred dividends is divided by the weighted average common shares outstanding. So what this says is what is the net income available to individual shareholders, or what does the company earn that could contribute to shares. The price earnings ratio shows us what the stock market's expectation for a company's growth is in earnings, dividends, and opportunities. So the higher price earnings ratio, the better earnings potential we see for this stock in the future. This is the market value or price per share divided by their earnings per share. And we would watch this from year to year in order to predict whether we had a growth dividend or a growth on the market of a share and whether we would decide to purchase that share. The dividend yield tells us about the cash dividends relative to our stock market price. So this is our annual cash dividend per share divided by the current market value per share. And the last item that we look at is the book value per common share. So this is our total stockholders' equity applicable to common shares. So this is the retained earnings minus preferred dividends plus our paid-in capital plus our common stock account divided by the number of common shares outstanding. So this shows us what amount of stockholders' equity is applicable to common shares on a per share basis. That is the end of chapter 11.